The mere mention of an IRS audit can send shivers down anyone's spine, whether you're a seasoned financial advisor, a diligent small business owner, or an individual taxpayer. This common anxiety often stems from misunderstanding and a lack of clear information. But what if you could replace that fear with knowledge, perspective, and a powerful sense of control? In this comprehensive guide, we're going to pull back the curtain on IRS audits. We'll explain precisely what truly triggers an audit and, just as importantly, what rarely does. Our goal is to empower you with the insights needed for robust tax preparation, proactive audit readiness, and unwavering tax compliance, transforming apprehension into assurance. Audits are frequently portrayed in dramatic, almost adversarial terms in popular culture. People often envision intense interrogations, accusations of wrongdoing, or punitive measures. This sensationalized view fuels unnecessary stress and can make the tax system seem daunting and unfair. However, the reality is far less theatrical and much more administrative. Most IRS audits are not about assuming guilt. They are about resolving inconsistencies and ensuring accuracy. They serve as a vital mechanism for maintaining the integrity of our tax system, not as a tool for punishment. For financial advisors, understanding this distinction is crucial for calming client fears. For small businesses and individual taxpayers, recognizing the administrative nature of audits can shift your mindset from dread to proactive preparation. It's about clarity, not confrontation. Let's start with a reassuring fact. For the vast majority of individual taxpayers and even many small businesses, an IRS audit is an exceptionally rare event. The sheer volume of tax returns filed annually means that most are processed automatically without any further review. The system is designed for efficiency. The IRS employs sophisticated algorithms and data analytics to identify potential discrepancies, but only a tiny fraction of returns are ever selected for examination. This means that if your tax return is accurate and consistent, it's highly likely to pass through the system unnoticed. This knowledge should be a cornerstone of your tax preparation strategy. This low audit rate should empower you, not make you complacent. It underscores the importance of filing accurate returns, as the system is built to trust your initial submission. For financial advisors, this data point can be a powerful tool to reassure clients and emphasize the value of meticulous record keeping. While audits are rare, they are not random. The IRS uses specific criteria to select returns for examination, primarily focusing on discrepancies and anomalies. Understanding these triggers is your first step toward robust tax compliance and audit preparation. It's about data matching and logical consistency. One of the most common triggers involves income reported by third parties that doesn't match what appears on your return. For example, if your employer reports your wages to the IRS on a W-2, or a bank reports interest income on a 1099, and these figures differ from what you declare, it raises a red flag. This is a straightforward data mismatch. Another significant trigger is when numbers on your return simply don't align logically. This could involve claiming unusually high deductions relative to your reported income or inconsistencies between different schedules. The IRS looks for patterns that fall far outside typical ranges for your income level or business type. These are often identified by automated systems. For small businesses, significant fluctuations in income or expenses from one year to the next without a clear explanation can also attract attention. Similarly, claiming large business losses for several consecutive years, especially if it appears to offset substantial personal income, might warrant a closer look. These patterns suggest potential areas for review. Furthermore, certain types of deductions or credits are historically more prone to scrutiny due to their complexity or potential for abuse. These include significant charitable contributions, large unreimbursed employee expenses, or substantial home office deductions. While legitimate, these items often require more detailed documentation. Cash-intensive businesses are also often subject to higher audit rates due to the nature of their transactions. The IRS is particularly vigilant about ensuring all income is reported accurately in these sectors. Maintaining impeccable records and internal controls is paramount for these businesses. Finally, errors on prior year returns that were audited or involvement in certain tax shelters can increase your chances of future audits. The IRS may follow up on previously identified issues or investigate participation in schemes deemed aggressive. Staying informed about tax law changes and avoiding questionable strategies is key. Just as important as knowing what triggers an audit is understanding what typically does not. Many common worries that keep taxpayers awake at night are rarely, if ever, the sole cause of an IRS audit. Dispelling these myths is crucial for reducing anxiety and focusing on what truly matters. Small mathematical errors, such as a minor miscalculation in a deduction or a rounding error, rarely lead to an audit. The IRS often corrects these minor discrepancies automatically and sends you a notice. These are administrative adjustments, not full-blown examinations. Don't let minor arithmetic mistakes cause undue stress. Similarly, filing your tax return late, while potentially incurring penalties, does not typically trigger an audit. The IRS is more concerned with the accuracy of the information you provide than the timeliness of its submission. Penalties for late filing are separate from audit procedures. Owing taxes, or even receiving a large refund, is also not an audit trigger in itself. The amount you owe or receive is a result of your tax calculations, not an indicator of their accuracy. The IRS focuses on the underlying data and deductions, not the final balance. Modest, well-documented deductions that are typical for your income level or business type are generally not a cause for concern. For example, claiming standard business expenses that are reasonable and supported by receipts will likely not raise flags. The key is well-documented and reasonable. Even if you receive a notice from the IRS, it doesn't automatically mean you're being audited. Many notices are simply requests for clarification, adjustments for minor errors, or reminders about unpaid taxes. Understanding the different types of IRS correspondence is vital for taxpayers and financial advisors alike. When an audit does occur, it's often far less intimidating than imagined. The vast majority of IRS audits are not in-person, confrontational meetings. They are typically conducted through correspondence, making them more procedural and less dramatic. This is a key piece of information for audit preparation. Many audits begin with a simple letter from the IRS requesting additional information or clarification on specific items on your return. This might involve asking for receipts for a particular deduction or documentation for a reported income stream. You respond by mail, providing the requested evidence. These correspondence audits are limited in scope, focusing only on the specific items questioned. They are designed to resolve discrepancies efficiently, not to conduct a deep dive into every aspect of your financial life. Providing clear, organized documentation is usually sufficient to resolve these inquiries. In some cases, particularly for small businesses or more complex individual returns, an office audit might be requested. This involves meeting with an IRS agent at a local IRS office. Even these are typically focused on specific areas of your return, and you can often bring your financial advisor or tax preparer with you. Field audits, where an agent visits your home or business, are the rarest type and are usually reserved for very complex cases or large businesses. Regardless of the type, the process is about presenting facts and documentation. It's a review, not an inquisition. It's time to reframe our perception of IRS audits. Instead of viewing them as a punitive measure, consider them a necessary part of how a large, complex tax system maintains accuracy and fairness for everyone. They are a quality control mechanism, not an accusation of wrongdoing. An audit does not imply guilt, nor does it automatically assume malicious intent. It simply means the IRS has identified an inconsistency or an item that requires further clarification. Your response, backed by accurate records, is what truly matters. This perspective empowers you to approach any IRS inquiry with confidence. The most powerful tools you possess against audit anxiety are accuracy, meticulous documentation, and a calm, informed response. Proactive tax preparation, guided by a clear understanding of tax laws and diligent record keeping, is your best defense. This approach transforms potential stress into a manageable process. Understanding IRS audits is not about fearing them. It's about empowering yourself with knowledge. For financial advisors, this means guiding your clients with informed reassurance. For small businesses, it means establishing robust record-keeping practices. For all taxpayers, It means approaching your tax obligations with confidence and clarity. Don't let the specter of an audit overshadow your financial peace of mind. Embrace proactive tax preparation, prioritize meticulous record keeping, and stay informed about tax compliance best practices. Remember, knowledge is your greatest asset in navigating the tax landscape. If you found this information helpful and empowering, please give us a like and share it with others who might benefit. Your engagement inspires us to continue providing valuable insights into complex financial topics. Subscribe to our channel for more expert advice on tax preparation, financial planning, and achieving your economic goals. We're here to help you build a foundation of financial confidence. Thank you for watching, and we wish you a blessed and financially secure day.